Return is fundamentally an investment timeline. Suppose you have invested money here. Negative is always taken as investment. You will get a cash flow at the end of the tenor, so it will be positive. So, investment is negative, cash flow received will be termed as positive. And what we measure is what we call it as timeline. Now in a timeline, the basic focus is I am investing here, I am getting a cash flow received over here. If my investment is equal to my cash flow received, as an investor, I will not appreciate it. Why I will not appreciate as an investor? For a simple reason that I did not receive any benefit out of it. So always my investment should be less, my cash flow received at the end of a tenor must be high. So when my investment is less and my cash flow at the end of the tenor is high, this is what we call as return. Return is cash flow minus investment made. Now there are three aspects. Aspect 1, we call it as, is this cash flow recurring in nature? Aspect 2 is what we call, is it cash flow one time? Take a simple example where we are talking about person has invested 10,000 rupees and person has received 15,000 rupees. This is at T0, this is at T1. Now what do we say is the investment requirement? T0 is 15,000, T1 is 15,000, T0 is 10,000. So the person we say has made a profit of 5,000 rupees. Correct? Now this 5,000 rupees which the person has made as a profit, we can say is profit for the investment during the timeline. What have we missed here? We did not talk about how much time it took to get this 5,000 rupees. Correct? Now when we say how much time it took to get this 5,000 rupees, when we are not considering that point is called a holding period return. I might have invested 10,000 for 2 years, I might have invested 10,000 for 5 years, I might have stayed invested 10,000 only for 3 months. But I have got a return of 15,000 rupees, then I am set to make a holding period return of 5,000. Now when we say return is always for the purpose of understanding measured as percentage. Right? Now when we say it is measured as percentage, we are here talking about how much percentage it comes to. For that, we make a small calculation here. The same timeline of 15,000, I have invested 15,000. This is called price at 0, price at 1. P0 is what I call it as 10,000, price at 0. Holding period return formula runs like this. It says HPR is equal to P1 minus P0. This will be my profit divided by P0. So I will say 5,000 divided by 10,000. So the return that I would get is 50%. Now this is what we call as holding period return of 50%. Now the only point that we have ignored it here is timeline. In what time I have received the holding period return. Now that's one aspect. Second aspect which we say is nominal return. Whenever we are investing, a general question which comes to every investor is what? I am staying for, let us say, 1 year of time or 2 years of time. My concern is only one. How long will I get my return? I don't ask. I ask how much return I get on a yearly basis. It is easy to understand and assimilate. So whenever you say investment rate or return is 10%, we either call this as nominal rate or call this as stated rate or call this as annual rate. All are one and the same. Nominal rate, stated rate, annual rate. All the three are one and the same. But the point is, if the same nominal rate is paid on quarterly compounding, then this nominal rate will increase because of its compounding nature. That increase we are calling it as effective rate. Right? Let's understand this illustration. 10% we are investing, This you say is nominal rate. So nomino is 10%. It says there is a quarterly compounding. Compounding per year is 4. 4 times you are compounding. Why it is 4 times compounding? Because it is paid quarterly. Now when you are compounding quarterly, what will happen? We use this effective rate as 1 plus R by M raised to the power of M minus 1. Now when you do this, you will get it as 1 plus R is 10% divided by 4 raised to the power of 4 minus 1. This roughly comes to 10.38 in percentage terms. Right? Now this 0.38 which we received extra is because of this compounding on a quarterly basis. This rate is different from the nominal rate. So this difference is what we exactly call it as effective rate of return. Right? Now the third area which we try to elaborate is if a person is investing. So let's say there is a stock. Whenever you invest in any stock, 99.9% you will not get positive returns every year. Sometimes you may get negative return also. When that is the case, let's say first year person got 12%, second year person got 10%, third year there was a negative market scenario, you got minus 15%, fourth year market was extremely well and company performed also well, you got 25%, fifth year you got about 30%. Now if we slightly make a calculation, for calculation purpose let's say it is 5% here. Now slightly if you calculate 15 plus 10, 25, 25 minus 15 is 10. Now 10 plus 20 plus 30 will be 60%. Correct? Now 60% divided by 5, on an average in 5 years I got 12%. That is the general perception. But the point is, this has not considered these two extreme values. So when this has not considered these two extreme values, we say that this 12% return is not sensitive. To make it sensitive, what I do? I go for something called compounded annualized growth rate. Compounded annualized growth rate is nothing but a geometric mean. We call it as geo mean. If we try to evaluate in Excel, the string is geo mean. You just select the numbers. One point that has to be understood is whenever you have a negative sign, geometric mean cannot be calculated. Why? Because geometric mean is nothing but nth root of products. When you say it is nth root of products, you are multiplying this and finding the root of it. So for this, if I were to write the mathematical formula, it will be like this: 0.15 into 10 into minus 0.15, 0.2, 0.3. When I take fifth root of this, rules of mathematics say it's a surd. Root is not possible. So in order to eliminate this issue, what we will do is we will add for everything 1. This becomes 1.15, 1.1, this becomes 0.85, 1.2, 1.3. Now I will take the root of this, which is quite possible. The root of this, whatever comes, that will be your compounded annualized growth rate. Right? Now the last return which we talk about is internal rate of return. Internal rate of return exclusively is the rate at which my investment and my outflow and inflow are same. I have made an investment, this equals to my, this is my outflow, this is my inflow, and I say it is matching. The rate at which it matches, it is called internal rate of return. How is that possible? To just elaborate this, let us say we are investing 10,000 rupees and we are receiving 15,000 rupees after 1 year. The tenor is 1 year. Correct? Now I am talking from the point of view of present value of this money. So it means minus 10,000 is equal to 15,000 divided by 1 plus IRR. The rate at which 15,000's present value becomes 10,000, that is the rate which we call as internal rate of return. Right? So internal rate of return majorly focuses on equating your future cash flows with respect to present cash flows. That's all for today.